Welcome to the Realty Rundown, the podcast that cuts through the noise of the real estate world. Your hosts, seasoned industry experts Nick and Nate, are here to guide you through the entire process. Each week, they're breaking down the latest market trends, decoding complex jargon, and sharing insider secrets you won't find anywhere else. Whether you're buying your first home, selling a property, or building an investment portfolio, we provide the clear, actionable advice you need to make your next move your best move.
All right, welcome back to the Realty Rundown. I am Nick Wyse from the Nick Wyse team at RE/MAX Results, and I'm your host today. And joining me, as always, or almost always, is Nathan Schwartz.
Still catching some flack for taking a couple weeks off, but I'm here. We're all good.
How dare you miss two? No, you're fine. So everybody, today we're going to do a couple quick things. Starting off, we're going to look at Indiana housing markets and Elkhart County housing markets. Let you get a quick insight into what's going on with our local markets. And then we're going to jump over and we're going to talk about variable rate or adjustable rate mortgages, or as they get called in the industry, ARMs, adjustable rate mortgage. So, but first, I want to mention just one more thing real quick, because Nate, we had a win. I think you saw this too, that I get excited when a thing like this happens. So on episode 28, actually, we talked about this. We talked about trigger leads, and more specifically, a piece of legislation that worked its way through the House. Well, it just unanimously passed the Senate. It is called the Homeowners Privacy Protection Act of 2025, and it basically severely restricts the use of these trigger leads, which, if you recall episode 28, that's essentially when someone goes in and applies for a mortgage, it's going to, boom, trigger leads. And it's an abusive practice, basically, where credit reporting agencies sell consumers' data without their knowledge, without their consent, to other competitors and to mortgage brokers, and they sell them as leads. So shady, to say the least.
Yeah, I was going to say, to say the least.
Yeah, it must be pretty shady if the entire Senate voted for this bill.
Yeah.
They can't agree on anything. So huge win. Love that we got to discuss it here on the Realty Rundown, and now it is going to President Trump's desk to be signed into law. So nice. Good job. NAR was huge and very instrumental in that. The National Association of Realtors, this was one of their big initiatives that they were pushing, said we got to get rid of this. This is bad for homeowners. It's one of the reasons I believe very strongly in NAR and why I'm a realtor, not just a real estate agent, because they do things like this. This has basically no benefit to realtors. Really doesn't, right? It just helps consumers. And I think there's often that forward-facing side of like, oh, it's a big trade group, the NAR, and they must be all evil. Not all evil. Not all. Yeah. Probably not evil at all. Okay, moving into the Indiana housing market update. So Nate, I wanted to real quick jump in and cover what we're seeing from the Indiana state, and I've got a little graph that we got from our buddies at the State House. So I'm going to throw that up there. But basically, we've got statewide home sales that have risen 3% from May to June. So this is their latest data. So 3% up over the last month or so that we have data, which is over 7,000, almost 8,000 closings. And the figure from year over end is actually up about 12%. So here in Elkhart County as well, we've seen our sales numbers stay almost flat. They actually went down one, and we've got our July numbers in. So we had in Elkhart County in 2024, we had 187 sales. This year we've got 186. So we lost one sale. But in the meantime, the average sales price has shot up over 10%. So we are now at just under $300,000 as an average sales price here in Elkhart County. Pending sales as well. We've got some information from our August. We're only to the 19th of August as the date of the recording here, but they are already up over 13% from 2024 as well. So Nate, what do you make of it when you see those numbers?
Yeah. I think it shows, despite mortgage rates holding above 6.8%, demand remains solid. So both buyers and sellers expect continued strength in our market despite higher rates. So they're navigating through higher costs, but demand isn't slowing.
Yeah, and I mean, from our end, just the Nick Wyse team, I would say that's pretty accurate. I know I've been staying pretty busy, Nate, and from the last time we checked in and talked, you were extremely busy. Yeah, had appointments like all day, every day. Yeah. So, yeah, working them late hours. Sorry, Joanna.
She's good with it.
Keeping him out late. That's right. Oh man. Well then so that was just our quick market update. Now I really want to jump in what the bones of the episode are about. which would be adjustable rate mortgages. And we're going to talk about this. I was actually surprised we hadn't really talked about it before. I think we kind of briefly touched on it in the past, but
briefly.
ARMs are really popular right now, to the tune of the ARMs, the adjustable rate mortgages are making up about 10% of all mortgage applications, which is a 3-year high.
Yeah.
Which it makes sense, right? I mean, I'm not surprised we're seeing that be a 3-year high because
right.
Yeah, great.
and yeah, right. And I assume it's because, rates for ARMs are still lower than fixed rates, I assume.
Right. They are. We're going to talk about some of the reasons that they are. But, right now, that's 30-year fixed average, and this is the average, is hovering about 7%. The ARMs are hovering closer to 6.6 to 6.8. So obviously, that's, you're like, oh, 0.4, what is that? It makes a pretty big difference. Actually, I've got some stuff I'm going to throw up here on the screen again, just talking about, these are a little bit bigger jumps. But Nate, you'll be able to see this too, just going from 5 to 6 to 7% rate on a $240,000 loan, which again is 20% down on a $300,000 house, because that is our average right now is $300,000. So you're putting 20% down because you don't want to pay PMI. So that leaves you with $240 as your loan. So the numbers right here, and this is without taxes or anything else included. The difference is over $300. As a 5 to a 7%. And that's again, just a month. And that is on average. The numbers can be starkly higher than that too, with other variables included. But really it's all about the ARMs making things more affordable now.
Yeah. So Nick, if you could break down how ARMs actually work.
Yeah. So ARMs are basically an initial fixed rate period. So like in a 5-to-1 ARM, and there are many ARMs. In fact, we have an example of the many ARMs. I'll put those on the screen. You'll like this when you get to see it.
I was going to say, I got to see that one.
So there's like a 5-to-1 ARM, which is basically where the rate stays fixed for 5 years and then adjusts annually. There's also 5-2 ARMs where it adjusts twice a year. That's the 2 coming in. So the image that you're going to get to see, Nate, is a Vishnu holding his many mortgage applications with his many ARMs. I apologize.
Curious if it'd be something similar to that.
I apologize to any of our very strict religious Hindu friends. I hope this is not offensive. I did a little research and it was like, nobody's going to get mad. I really, really hope. Please don't bash me with the many arms of Vishnu. But basically, the way they work, the introductory rate is lower and it's fixed for a set amount of time, but its rate will then change, but based off of current economic indices. So the key thing to understand, I guess, is that there are caps and limits on how much the rate can increase for each period over the life of the loan, and that there are so many of these different kinds of loans. Yeah.
So, I would say smooth for the short term, but potentially volatile long term.
Yeah. And there are some products that are like kind of crazy volatile. But yeah, the definite advantage are those lower initial rates, helping people qualify for more home right now. And then if you plan to resell or refinance within that fixed period before those rates can adjust, it just makes good sense. So it is a risk though, right? You're taking a little bit of a gamble, because after those rates adjust, there's certainly no promise that they're going to go down. Payments could spike, creating what we consider in the market as a payment shock.
Yep.
There are even some options out there called option ARMs. They're very flexible, but they're very risky, and they could actually lead to what is called negative amortization. Nate, do you want to take a stab at what negative amortization might be?
So to my understanding, isn't that when your loan payments are less than the interest that is accruing on the loan?
Yeah, that's exactly what it is. So you have your beautiful amortization tables, and they're showing you like every time I pay this much, this month goes to my interest, this month goes to my principal, and this is my balance when I'm done. And I can see that trickling down. Yay, I'm paying off my loan. Mm-hmm. Well, with these things, the rate can adjust so much that it is actually negatively amortizing your set payments. You're saying I'm only going to pay this much every month. Well, it can actually increase the interest so much that now you're paying no principal, and actually you're paying more interest on top of that. And right. The lender has a right to adjust that payment. Then obviously, they're not going to let you get to 125% typically on your principal. Nobody wants to loan more money than a home is worth. So at that point, they're going to say, guess what? Your payment is going up. And it can be, as we mentioned, that payment shock, because it can be rather drastic. I had a little image of this one too. I think I let it fall off. There we go. I've got that up on the screen for the peeps to see right there, but it's very, very tragic image, very scary. But yeah, really, that's the option arm. They're not. I'm not going to push any option arms on people.
Yeah.
I think they're too risky. But the 5-1s and the 5-2s and some of these other plans, I think they've got a place.
Yeah, for sure. So, kind of switching gears here, do you see any patterns among which type of buyers are opting for arms?
Oh yeah, big time. So, in large part, it's our younger buyers, and again, I think that's because they're looking for affordability. They're wanting to get into the houses they want to be in. So right now, if their rate is at 7%, that might make it trickier. Just dropping down to that 6.6 can actually open up a lot of things for them. So it's younger, higher income buyers typically. They've still got good credit scores. They're not afraid of a large mortgage. They're not afraid to try a little risk. So that's really who it falls onto. And they're going to benefit if it goes well, and if they plan things well, they're going to benefit from some upfront savings. I will also have to mention that we've got kind of a heads up that many home buyers are essentially, in a way, it's gambling. 56% is the stat that I've got of new buyers are basically counting on the ability. When they're surveyed, they're saying 56% of them are saying we will be refinancing this in the next 5 years. That's great. Again, if rates go down. If they don't, you're not going to want to refinance, right? But if you're in an ARM, you don't have a choice. It refinances itself, and that rate goes up, meaning payments go up and interest goes up.
Yeah. So again, risky.
Yes.
Well, I'll sum it up real quick. So Indiana and Elkhart home sales are rising despite mortgage rates. Adjustable rate mortgages are surging as rate alternatives comprising roughly 10% of applications. ARMs offer lower initial rates, best for those planning to move or refinance before the reset, but carry the risk of rate increases later. And then lastly, younger affluent buyers are more likely to choose ARMs, but they're also gambling on timely rate drops.
Yeah. Yep. I think you nailed it, man. Really it's about risk tolerance. Obviously the younger borrowers are going to be more, risk prone because they've got more time. If things do go wrong, obviously you've got more time to straighten it out. If you're an older fellow like myself and you want to try this avenue, and it doesn't go well, you could really be setting yourself up for a loss of some retirement income, some things that you'd like to rather than paying interest, be socking away some money. So it makes sense that it'd be some of the younger ones. What I really want people to do before they go out and just get an ARM, is maybe buy some Bitcoin or gamble on professional sports. These are much better ways. No, these are not good ways. These are not good ways to manage your money. I'm kidding. What you definitely want to do is really dive deep, use payment calculators, talk to your mortgage lender early and say, is this a product that I should be considering? Make sure you deeply understand the terms. Like I said, there's many, many different ARMs, the Vishnu ARMs. Make sure you understand what contract you're putting yourself onto when you get one of these mortgage, and don't just rely that rate cuts are automatically going to happen, because none of us have a crystal ball. So, Nate, I think that's it. Is there anything else you wanted to hash over?
No, I think it's pretty good.
All right. Well, friends, appreciate you again tuning into the Realty Rundown. I'm going to hit the theme song here.
Love it. Here we go.
And Nick knows all the answers to your real estate questions. We'll see you next time.